We have Apurva Prasad of HDFC Securities also joining us in our studios right now. Apurva, thanks a lot for joining in. Like you heard Rima, the IT sector did outperform, had a lot of tailwinds going for it. But from the record levels, we've seen a bit of correction on both Infosys, TCS and the sector itself. 2019, does it look as good as 2018 or is the best over for the near term at least?
So I think there's a very strong demand uptick, which is currently there in the overall system. So while 2019 was 2018 rather was a very strong year, I think that demand itself can keep growth rates at elevated levels. So I mean, we've recently extensively checked, with a large set of competitors as well as the channel partners and large product companies in the US. And I think one thing which is coming pretty much across the board, that the demand environment is pretty strong. So you look at some of the lead indicators for the sector, so one is the contracting data. That's pretty much accelerating, if you see across the board at a macro level. And the second thing is the hiring metrics, so if you see that, it's probably the best ever in the last 3 to 4 years. So I think despite the fact that there is non-linearity in there, but there are very, very key sort of variables which are pointing towards an uptick in demand.
But Apurva, the macros turned a lot more uncertain, right? There are tangible fears of a slowdown in US growth. How much of an impact can that have on IT companies' growth rates? Because right now, the street expects that growth in FY19 will be, FY20 will be better than what we saw this year. So if these macro risks materialize, do you think, those growth rates may not improve and therefore there is a risk to the EPS estimates?
So I think there are two ways to look at it. So one was the known risk, which is there in the system, which is more on the aspect of the shrinkage in legacy, which is typically going down about 3 to 5% annually. So I think one part is that the known risk of legacy shrinkage, I think that's a lot lower versus what it was a year and probably a couple of years back. The unknowns, they continue. I mean, the unknown macro risks have already been there. So whether it is tariff wars or Brexit, whichever way it happens, look, we know that US GDP is slowing down versus what it was this year. A lot of discretionary spending was probably back-ended to the year, and I think that's probably more long-term element to it. So while I think the uncertainty in macros, that may probably go up, I think the biggest known risk which was there in the system in the last couple of years, I think that is significantly down.
All right, Apurva, thanks a lot for joining in with your views. Meanwhile, on a quick programming reminder, CNBC TV 18 launches a special initiative in partnership with the National Stock Exchange. Every month, we tell you how investing in the stock market or equities makes one financially disciplined. This is a monthly program to inform and educate investors about smart investing and enabling the journey to wealth creation. Catch our special coverage all through the day only on CNBC TV 18.